We all know to buy in a discount and sell in a premium. Everyone says that, right? It's common knowledge in the trading world. But the problem is 99% of traders are measuring premium and discount completely wrong, and it's costing you trades and opportunities every single week. So what we'll do in this video is show you how to find true premium and discount based on real order flow and how professional traders find premium and discount levels, so you can learn to trade based on facts versus just what's being taught everywhere on YouTube these days. As we know, the premium and discount is defined like this. So premium is what we call overpriced relative to fair value. Discount is underpriced relative to fair value. And on the right here, we can see a sort of representation of how most traders determine premium and discount. So we have an oversimplification here, but we've got the candle, a range, and then the upper 50% is what's considered premium to most traders, and the lower 50% is what's considered discount to most traders. The reason these things matter is the larger traders, the institutions, etc., the ones that actually move the market, are typically executing their trades, their longs in a discount level and their shorts in premium levels. So we want to make sure we understand where premium and discount is so we can more effectively ride their waves and capture trades at favorable positions, right? So it's a universal principle of market logic. No matter what strategy you trade, this video will apply to you. So the way that most retail traders are trying to interpret premium and discount is the way that's common with ICT traders, smart money concepts traders, you name it. Most traders who are self-taught are learning to measure premium and discount in this way. Again, where premium is the upper 50% of a range, discount is the bottom 50% of the range, your medium point here. The problem with this is that it assumes that the market cares about an arbitrary 50% level, because there's nothing else that makes this price point important other than that fib or that range you've drawn across. There is literally nothing based on data or logic that makes that price point important. The other problem is that this type of way to measure premium and discount treats all prices equally between the high and low of the range. It assumes that every price point as we move up and down is equal. And what this is, it's an overly simplistic approach. Okay, again, it doesn't take into account any true market mechanics or any logical factual data, and causes you to completely miss when the market is actually in discount and premium, which then affects your ability to take trades at truly favorable prices, or you'll just miss trades altogether. So I'll show you that in just a second. The way that professional traders find true premium and discount is by using volume, because volume takes into account executed transactions. It does not treat every price equally, but it shows us where behind the candlesticks where the most or least interest in price is. Now, this is something that can't be spoofed or faked. Volume is based purely on executed trades. So it's not passive trades, it's aggressive executed trades that have occurred. And using a volume tool or volume profile, we can see behind the candlesticks, getting an insight into the market order flow. And not only can we now see where premium and discount truly is, but we can also now build more of a story based on facts and transactions and get a better idea of where the market is moving to next, which we'll get into in just a second. So with a volume profile, we'll have a look on TradingView in just a second and run through it. But a high-level overview here is that with your volume profile, it's drawn across a range. So this is the full day's range of the regular trading hours here. With a volume profile, it gives you what's called a value area high, a value area low, and a point of control, which is the red line. And then you have all the volume, as you can see in the histogram along the side here. Now, your value area high, which is the upper blue level, that is what we call a high premium price point. So that's an expensive price point. And the value area low is deep discount. So that's where you can get your best discount entries. And then the red line here is which price had the most transactions occur, the most aggression occur, and that will be marked as your point of control. Now, this is what professional traders refer to as fair value. This is your true fair value price point. If you think about an auction or think about a market, any price that is below fair value is a discounted price, right? If you can get something that's below its fair price, then you're grabbing it at a discount. If you can get something above its fair price, then it's at a premium. You actually find premium and discount by looking below fair value. This whole level below this red line here is your discounted area, with deep discount being down below the value area low, and vice versa. Your premium price point is anything above the red line, with your high premium being just above the value area high here. So let's have a look at this on the charts and expand more upon this. So let me show you what the volume profile can do in terms of premium and discount versus ICT. So here's the volume profile drawn from 9:30 to 4 p.m. Eastern Time, which is your New York main session on the S&P 500 futures. Now, an ICT trader, if they're going to look at the premium and discount of this range, they're going to go from the low of the day to the high of the day, right? Mark it here. So an ICT trader is going to look at the midpoint of this range here, highlighted in the green square. They're going to look at the midpoint of this and assume that anything from here and below is discount, and anything from here and above is premium. So if they're looking for a long trade, they're waiting for price to come all the way down to either the midpoint of the range or below in order to get their long entry. And they assume that if you take a long up here, then you're buying in premium. And you can see in this instance here, you would have totally missed the trade. This is a nice long setup here based on the volume profile, but because you're sitting around waiting for price to pull into what you think is a discount, you totally missed the trade and totally missed where true discount is. So if you remove that ICT SMC premium discount measurement and instead just look at the volume profile. The red line here is point of control, that's your fair value price. Now remember, anything above fair value is premium and anything below fair value is discount. So actually, discount begins right here. It's not all the way down here. Discount begins right below 6372. So you immediately have an edge above an ICT or SMC trader in that you're not waiting for price to pull all the way back down. You know, if you're bullish, you can start to look for longs the moment we pull below fair value. And the same way, if you're looking to short, I would not short a profile that looks like this. You volume profile traders will understand. But if you're looking for shorts, you'll know that you can look for anything above this price. You can start to look to short the market. So again, this applies to any strategy. But if I'm trading volume profile, I'm looking to trade from high volume nodes. So based on my strategy, I'd be looking for longs around 6368 to 6365. That sort of 3-point price range in here. You can see that's where price pulled in below fair value, and that's when that long reversal happened. But no matter what your strategy is, if you can truly understand where fair value is using volume profile, you have an edge above these other traders who are incorrectly measuring premium and discount. The ICT SMC version measures premium discount on a simple midpoint with no market participation considered, no market mechanics considered, nothing. Right, it's an arbitrary level. But using the volume profile, you are finding premium and discount based on actual traded volume, referring to the market's memory. So you're not using arbitrary levels anymore, you're using logical levels based on real transactions and order flow, meaning you are trading with the auction and not guessing based on where an arbitrary halfway point is. So this works across any strategy. I trade purely using the volume profile, but if you trade ICT, SMC, Wyckoff, whatever it is, simply incorporating this into your trading and understanding when we are actually trading in discount versus premium and where those discount and premium zones really are is going to greatly improve your accuracy and help you to find more favorable trades. Incorporate a bit of volume profile, a bit of order flow like this, and you're going to see your results greatly improve over time. So this is just one way to use the volume profile. I personally trade purely using the volume profile. If you want to learn my complete volume profile strategy, you can check out my course linked in the description below. We also have a new volume profile community that will be launching next month. But like the video if you found this helpful. I'll be posting more free, valuable content every week here. So subscribe and let me know down below if you enjoyed this video.